Okay, so tonight we're going to try to cover chapter 2 and 3 of the financial review. I'm going to go over not everything, but when I think that what I think that is important, we'll go over. I also wanted to let you know that on Canvas, I set up a sheet on there for extra problems to practice, things that I want you to know for the exam 1. So I just put that up for the class. So you'll have access to that and make sure you know how to do those problems. I have someone that's saying that they have COVID hanging in there. I have heard that it's going around again. But I know a lot of people get sick during the summer. I always have gotten sick at the summer, like the tail end of the summer. So I usually get sick more in the summer than I do in the winter. So I think that's kind of what we have going on in my house. My husband wasn't feeling good over the weekend. And then my daughter had fever yesterday. And today I'm not feeling great. Oops. Okay, so we're going to start with our financial statements and the accounting system. And we talked a little bit last week about the financial statements. The ones that get introduced in the chapter, in the chapters when we go through account principles class. They talk about the income statement, balance sheet, the statement of cash flows, and also the retained earnings. So we went through those a little bit last week. And when we're going through the managerial accounting and we're talking about all the different hang on one second. I have to see if I can mute somebody because I hear a back noise. Let's see. Yeah, if you don't have your microphone on mute, if you could just hit mute for me. All right. So we went through those a little bit last week, and that's going to be introduced, you know, how things flow through journal entries and flow into the financial statements. So that's why I wanted to refresh all of those basics to make sure that when we're talking about other things, you understand what's going on with the financial statements. And it's, you know, hard to understand if you haven't had that in a little bit. So this little refresher helps. Okay, so we talked about when we have an organization, we have lots of transactions, and those transactions need to be recorded into an accounting system. So obviously in principles class, you're not documenting it into an accounting system. You're learning how to do it by hand and what's actually happening in the computer systems. So the transactions are going to start from someplace. Usually you're selling a product or you're selling a service, and those transactions are going to lead to things that have to get entered into the accounting system. So if we're selling product, this first one on the list says bills from suppliers. So if we're buying products from suppliers, we're going to get a bill for that. A lot of times we have an account, and so we put that in the system, and it's called accounts payable. We'll enter it and we'll pay it later. We also have sales receipts. So we're going to sell those services, and we're going to sell that material, and we're going to receive money. So we have to enter our sales receipt to keep track of what are we selling, how much of it are we selling. You'll receive payments with checks. You might issue purchase orders. Not all companies issue purchase orders, but some do. We'll have payroll. So we have to have all the payroll records on who's getting paid, how much, and what taxes need to be paid. So they'll have records for that. And we also have bank statements. And so we'll have every month you would want to reconcile your bank statement to see if all of the cash transactions that have happened through the bank are actually recorded on the books and they're recorded correctly. So the way that we have the accounting system set up is we have something called an account, which the account can be either a name or it can be a number and a name. A lot of companies use numbers, and they typically will have, you know, the number scheme kind of stays the same across the board. I mean, obviously everybody's numbers are different, but usually if it starts with a 1, it's an asset. If it starts with a 2, it could be payables, liabilities. If you have 4, sometimes companies across the board, the number 4 usually represents a revenue account. 5s and 6s could represent, you know, a cost account or an expense account, sometimes 7s. So each company sets it up different, but a lot of times when you're looking at the general ledgers, you'll see all these lists of accounts, and those account numbers tend to stay kind of the same throughout, you know, from one organization to another. So, so we have a list of these accounts: asset, liability, equity, revenue, expense. And you also have a general ledger. And the ledger, you can run a ledger detail, which will show you all of the transactions that happened within that account. So we have the account, let's say cash, and I want to know what were all my transactions that happened for a particular month. I can run a general ledger and see the detail that shows me what happened in that month. So this just kind of helps you look to see how things are kind of organized in the accounting software. You have your asset accounts, and that's all the ones that might start with the 1s, and you have your liability. All those start with, you know, 2s. Equity accounts could be 3s. And so all of those accounts are in the same bucket, and then they'll pull over to the financial statements accordingly, how it's been set up through their chain in the software. So here's a list of the asset accounts. I feel like these slides, if you're struggling a little bit with the questions on the homework and not remembering a whole lot from that first class, these slides will help you remember. So those asset accounts, cash, land, buildings, equipment, things that you have that are going to benefit you in the future. Accounts receivable falls in there because this is money that on products that you've sold or services you've sold, and they're going to owe you in the future. So you're going to receive money in the future. So that's something that benefits you. Notes receivable, same thing, but remember that is the one that's set up where they have a set payment that comes in every month. And then also the prepaid, which could be your insurance, something that's benefiting you in the future. And here we have the liability accounts. Those are things that you owe, you're liable to pay. So accounts payable is things that you're buying. You're going to have to pay those off usually within 30 to 60 days. Accrued liabilities just means that you know that you have something that you owe. You just haven't received that bill for it yet. So you set it up in your expense. And then the other side is a liability because you know that that expense is coming. That bill is going to be coming in. A notes payable is something that you have set up with a set payment every month. And then unearned revenue is one that people get tripped up on a little bit, but just remember that if you have to do a service for someone and you haven't done it yet, let's say I am contracted to do some accounting work over the next 2 months, and I'm charging them $8,000. Well, if they pay me up front, I have cash up front, then I need to get on my books. So I'll record the cash. The offset to that would be an unearned revenue account. I still owe them something. So I don't have a bill that I have to pay with cash, but I have services I need to provide. So even though it's not cash that I owe someone, it's services I owe someone. That is still a liability. That's unearned revenue. I don't want to record it yet as revenue because I haven't done it. So I'm going to remember that that unearned revenue is a liability account. And then here's our equity accounts. We have revenue and expenses, which rolls into our retained earnings every year. And we have dividends and common stock. So this just shows you the equation: the asset equals liabilities plus owner's equity, and it breaks out the equity for you. So you can see what's actually happening when you have dividends that are paid out or revenues coming in, expenses going out. This helps you when you're trying to figure out how you're supposed to come up with, you know, balancing on that each side of the equation. Each transaction that we do, it has to maintain and stay in balance. That asset has to equal the liabilities plus equity. Well, sometimes we forget, what am I doing with my expense? Which way is it going to go? Like I'm seeing it hits a debit, it debits an account for expense, but what's actually happening to my equity? when I'm paying that expense. So these little slides can help with that. And then here's an example of a chart of accounts. So under assets, we have cash. You see how it's labeled 101. So those assets start with a 1. We have liabilities, accounts payable, unearned revenue. They're starting with a 2. And then we have equity. So we have 3s for our retained earning and dividends, common stock. We have 4s for revenue, 6s for expenses. So this is in line with what you normally would see as far as a chart of accounts, the numbering scheme that they use at an organization. And you can run a list of those when you work for an organization. You can run a list. So let's say you're in marketing, and your marketing team has to put together different events throughout the year. You put in your budget together. You may have a list of accounts, and you may only have your advertising accounts or marketing accounts that you're going to be using. And then you'll classify your different events that you're having during the year based on those accounts. Each organization may keep track of those types of things differently. So if you have lots of events, they may have several different types of expenditures for that advertising. You could have different accounts for advertising on radio, advertising on print, like a sign, or maybe it's documents that are getting sent out. So all of those can have different account numbers, and you may be given a list of accounts. So it'd be just a chart of accounts that they give to you, and this is what you use when you're setting up your budget for your marketing team for that next year coming up. All right, so remember we talked a little bit about that double entry, debits and credits. I know a lot of people get confused with that when they first learn it, so hopefully you'll have kind of mastered that through that first class. So the left side on a T account, the left side is a debit, the right side is a credit. And so remember, we just have to be in balance. We can have several numbers that are debited, several numbers that are credited, but in the end, when you're looking at your transaction, you should have both sides equal the same amount of money. This is another great slide to reference if you need to have some help remembering when you're doing journal entries and I have an asset and I know that's got to go on the books. What is my normal balance? What am I normally going to be doing? The normal balance for an asset is a debit. So this slide can help you when you're trying to figure out, okay, this is my transaction. I know I have to do this. I can't remember if I'm supposed to do a debit or credit on a normal transaction. So this slide can be helpful with that. So anytime you have a liability, the liability account normally will be credited. And then the debit is going to be a separate account. So if I'm setting up an expense in my system, let's say I'm setting up a utility bill and I want it to go to electric and gas, I'm going to debit my electric and gas expense account. My credit's going to be that liability, which is the accounts payable control. That's telling me that I'm going to owe that money in the future. So it sits as a credit until I'm ready to pay it with my cash. Well, my cash is an asset, which normally sits as a debit balance. So when you're looking at your cash account, you should see a positive number. So when I go to cut the utility bill, what happens is I'm going to credit my asset because that cash is going out, and I'm going to debit my liability to wipe that off my books. So I hope, that kind of helps you understand, like the normal balance is a debit for cash. But if I'm spending that cash, I'm doing the opposite. So hopefully this slide will help with that. Okay, and that's just expanded out. If you need help with, the expenses and revenue, if you wanted to see that, you can see it on that slide there. All right, and this is an example of a T account for cash. So what's happening is it's showing you on my left side is all my debits that happened in that period. And on the right side, that is my all my credits that happened in that period. So I can follow the transactions and I can look to see, okay, where am I at in my cash after all of this is done? So on the left with my debits, that's my cash coming in. On the right, my credits is my cash going out. So you would hope in the end, your balance, you're higher on the debit side. So when you're looking at a T account and you're looking at one specific account, this account doesn't have to balance on both sides. This is just giving you documentation of what has happened in that account, that one account, in that period of time. So maybe I'm just looking at the month of August. It's showing me all my debits and my credits that happened in that account. If I'm doing one part of the transaction, like purchase of supplies right here, this, let me see if I can write on here. Nope. Hang on. I gotta remember how to switch to my pen. Just a second. That top number right here, this purchase of supplies, 2,500. So if I'm buying that, that is just one transaction that happened in my cash account. When I'm actually posting it in my system, what's happening is the purchase of supplies for my cash is going down. So it's a credit because I've spent the money. I have another asset that's being debited, which is supplies. So my supplies on hand, that's going to be a debit. And so I don't have anything on the liability and equity side of my equation. We talked about that last week. Sometimes you have it on the same side. So I have two different asset accounts that are being affected, but I'm only seeing one part of the transaction on this cash detail that I'm looking at right here. So don't get confused that when you're looking at this, this has to be a zero. This is just showing you the transactions that happen within one of the accounts. So, so there's another part of that. And that transaction should equal zero on each side. So my supplies is 2,500, you know, debit, because that's my asset coming in, and then my cash going out is 2,500. Okay. Oops, this little marking did not come off of my screen. Clear. Nope, it didn't work. Clear all drawings. There we go. And go back to my mouse. Back one more screen. All right, so do you remember journal entries? So we're going to talk a little bit about journaling and making sure that we get our transactions into the right accounts. So we call them journalizing and posting the transaction. So what happens is on your ledger, when you're doing it by hand, you're actually marking what accounts are going to be hit. And then when you post it, it's actually going into those accounts on the general ledger. The computer software does the same thing. So I'm doing maybe I'm entering a bill in the system, which is through my payables module. I'm entering that. I'm selecting, okay, I'm paying Entergy. It's $500. I'm going to my utilities account, electric and gas, and it's getting set up into my accounts payable control account. Well, that transaction that I just entered is my general journal is showing, okay, I have these two numbers, but I'm not actually sending them over yet into the accounts until I actually post it. So once the invoice is in, a lot of times in the system, you'll have to hit post or post in a batch if you have a bunch of them at one time. Once you post them, then they will push over into the general ledger and show you those details of those transactions. So we got journal entries, and then we post them into those accounts. So it's showing, here's an example. It's showing you the date. It's showing the accounts that are affected, if they're debited or credited, and how much are they. And this is what happens. And then when we post it, it actually goes through to the account itself. So here's the account for cash. It's account number 101. It's showing me the dates and then how much money is posted into those debit and credit columns on the days that they were posted. And the ending balance is going to show up at the end of the report. Okay, so this is just showing you, okay, here's my journal entry. Remember I said we have two accounts that we usually are using in that journal entry. And so when we're looking at that cash account, we're not seeing both transactions. We only seeing what's happening in cash. So this is an example of what it looks like. So if I'm doing a journal entry and I'm affecting two accounts, they're showing you, okay, here's the two separate accounts. Here's the log that happens on the general ledger side that shows those accounts are coming in. So when you have the computer software, a lot of times they'll have a transaction number, and that number If I look in cash to see it through a report or on my screen, it's going to have a number assigned to it. And then if I look at the other account and I'm seeing the other side to that transaction, it's going to show me the same number. So in this example where the PR is, it's showing G1. It's just showing you, okay, that was the number that was associated with that journal entry, journal number 1. And it's showing it on both of the accounts. And so it does that in the software as well. All right, so we're going to process those transactions through that double entry. And we're identifying transactions. We're getting source documents in that we're going to be looking at to figure out what do we need to do with them. That second step is that analyzing that transaction to see, okay, where does this fit into the equation? And then we want to actually record the journal entry. Once we record the journal entry, then we're going to post the entry, which is just moving it into those general ledger accounts. Here's another example of that. I don't really know if we need to walk through all of these, but you'll have some of this in your homework. So this is actually, I think, one of the practice problems that I put on that paperwork to put on Canvas. So basically, I'm going through the purchase of a supply. We just did this on the other side. So what's happening is I'm spending cash and I'm buying a supply. So both are asset accounts. And so both of the parts of the transaction are going to be an asset. So only one side of the equation is being affected. But it's in balance. It's still going to have 0 in the end. I've just swapped one asset for another. So I'm analyzing what's happening. How is it affecting my equation? How do I record this? So this would be my journal entry. My supplies is a debit. Cash is a credit. And then it's showing you when you post it, you're bringing it over to those accounts. So I could ask you a question on if you purchase something, how does that journal entry look? And then you'll have selections to choose from the journal entry. If it says that it's bought on account, you have to remember that's not cash. An account means that it's bought on credit, and that's an accounts payable. That means you're going to be paying it later. You're liable to pay that in the future. Equipment, this is saying that we're buying equipment for cash and using cash to buy the equipment. It's the same thing. We're having one asset for another. And so we're doing our journal entry, posting it over to the account. And it's basically the same thing as supplies because it's equipment's an asset just like supplies. All right, so then we purchase. This is one that's purchased on a credit. And so we show our supplies as a debit, but what are we going to have a credit? Not cash, because we're not paying cash. It's going to be accounts payable as my credit. And then we carry those over to the accounts. Here's services. So instead of having a liability that I have to pay in the future, now I have revenue that I'm going to have to provide in the future. So I'm going to take that revenue, and maybe I've provided it this month. I'm going right to revenue. Maybe I am going to provide it next month, and I'm going to have unearned revenue. So either way, we'll have cash coming in as a debit, and we're going to have to hit that sale account or a liability account. In this case, we've done the services, so we're going to record it as revenue. Payment of expense. So now we're making the payment. We went through an example of that where you're paying cash out. Maybe it's your utility. In this case, it's your rent expense. So cash is going out. It's a credit, and then our expense account is going to have a debit. Okay, this is the same thing, but with salaries. And I'm just going to kind of scoot through some of these. Here's accounts receivable. I do like, a little bit about accounts receivable. Remember, that is when we're going to receive money in the future. And we're looking to collect cash later. So in this example, we're receiving that cash from something we sold before. So now we have the $1,900 in cash. We're just trading it for that other asset. So we're going to reduce the accounts receivable by crediting it, because we want to make sure we take them off the books. We don't want to show that they still owe money if they don't. Okay, so now we're paying the supplier $900 in cash towards the payable. So we've already purchased something. We had it set up on the books as a credit because we were going to have to owe it. It's a liability. Now, when we're paying it out, we're reducing that liability by putting a debit to accounts payable and crediting cash, because cash is going out the door. That's the easier part to remember. But if I'm in the process of buying something, I'm going to have to pay it in the future. What's my normal balance for a liability? It's a credit. And so that would be a credit. In this case, I'm not buying it right now. I'm actually paying for it. So now I'm going to do the opposite of that, which is debit. And I'm crediting my cash because it's going out. Now I'm paying a dividend. So it's the same thing. I'm reducing my cash. My cash is going out. So I know that's my credit part of the journal entry. My debit's going to be to dividends. And dividends with a debit will reduce my equity. Okay, this is the unearned revenue. We just talked about that a minute ago. So we have a liability on the books, and I'm collecting that cash. So my unearned revenue is going to sit as a credit because it is a liability, and the normal balance is of a liability is a credit. All right, so this one, prepaid cash. So we're paying out the insurance policy for benefits that are going to last over a 24-month period. My cash is going out. I'm crediting. My insurance is coming in. So since my insurance is coming in, that's an asset because I'm going to be able to have, use for this policy over the next 24 months. So the debit is going to be on the prepaid insurance side. And we'll talk about adjustments in the next chapter where we make adjustments each month for that policy. And we'll show how that hits the expense side. So right now we're just doing the cash part of the transaction. And then purchasing supplies for cash. We did that one already. Payment of an expense. We did that one. It's just showing you how you're processing it. And then this gives you a summary. So it's just showing you all of those transactions that we just went through. It's showing you the list of all the accounts, and it's giving you the detail through a T account is how it's showing it in this particular example. So they're showing you what's happening, all your debits and credits that happened in cash through all of those transactions. So so if you go through all the transactions that you did affected one of these accounts some kind of way. And so it's just giving you a recap here of what actually happened. So in a computer software, you could run a report and say, okay, I want the general ledger detail for all of my accounts, and I can see everything that happens within a particular period of time. Once we have those posted into the accounts, now we can prepare the trial balance. So the trial balance, we want to make sure we have all the accounts listed. Computers are great because they do this for you. They'll just spit out a report and say, okay, here's all your accounts and here's your balances for you. Unfortunately, when you're in class, you don't have that luxury. You have to figure it out yourself. So you're basically taking all of those accounts that you just, hit through all those transactions, and you're pulling that balance. What's in the account, pulling it over to the trial balance to make sure that it's in balance. You want to make sure your debits and your credits equal. All right, so here's the example. So it's showing you just the balances, not all the detail now. We're just looking at the trial balance, which only pulls the account number and the total. And it's going to tell you if it's a debit balance or if it's a credit balance in the account. And they should equal in the end. So, okay, sometimes we have errors on the trial balance. A lot of times in the computer software, you won't have errors on the trial balance unless something happens within the software. Sometimes you have to do updates. Sometimes there's some kind of issue where something's caught. Maybe somebody posted something wrong in the system. It happens from time to time where your trial balance can get out of balance. And a lot of times you have to have IT help you fix those issues. Even simple programs like QuickBooks, we would sometimes have to contact QuickBooks and get them to restore it because something was going on in the accounts. So it's always good to look. But when you're figuring this stuff out in your books, when you're doing it by hand, there's a couple things you can do is just make sure that you're pulling the right balances from those accounts. Make sure that they are in the right columns. Maybe you've added wrong, so go back and, recompute, see if you have the right totals. Verify that your transactions that you posted on those journal entries are correct, and then you brought those transactions over to the accounts correctly. And then make sure that your journal entries, also make sure your journal entries equal, because if they don't equal, then your trial balance isn't going to equal either. Okay, so then we have our financial statements that come last. So once everything's in the system, all of the transactions have posted through to the general ledger. We ran a trial balance, all the trial balance matches, everything's in balance. Now we can pull financial statements. So we're going to have balance sheets that show us at the end of this period, this is where we are. It's a snapshot. The income statement is going to show you that period of time. So I'm looking at the income statement maybe for the first quarter 2023. I can compare that to first quarter 2022. So I'm pulling all of my information for a period of time. And then I have my ending balances, which is that point in time again. These are the 4 financial statements. We talked about those last week. Here's an example. Obviously, income statement shows you all of your income and your expenses. We have our statement of retained earnings. So we're basically showing what did we start with, what was our income for the year. It's going to get added in, or if it's lost, going to get deducted out. Did we pay any dividends? And we're going to come up with an ending balance. And we have a balance sheet, which shows us all of our assets, our liabilities, and our equity, what the balances are at that point in time. And we're not going to talk about that. And we're not going into the ratios. Okay, so that is just a little recap of what I want you to know for chapter 2. All right, so let me get chapter 3. Thinking. Whatever, there it is. Okay, I was gonna say it's not opening. Sometimes I have everything on my external hard drive because I have too much on my computer, and sometimes it moves really slow. So we're going to talk about adjustments in here. So the adjustments are what we do, like for the prepaid insurance. So I purchased the policy, it's sitting as an asset, but does it keep that same value through the whole 24 months? No, it doesn't. I use it as I'm going, right? So it's benefiting me for the 24 months. So I have to expense a portion of it. That's what we're going to be talking about here. This is adjustments usually don't involve cash. It's usually adjustments that you put on the books that is transactions without cash. All right, so let's talk about the accounting period. So we talked about, that we can break this out. Usually it's in 12-month periods. It's not always a calendar year. It can sometimes, go with a physical year. This example is showing you, okay, here's a calendar year, and I have 4 periods. I can break them out into quarters. Some organizations run financial statements and do reporting monthly. Some do it quarterly, some semi-annually, sometimes it's annually. So, so just keep in mind that different organizations do different things. And we have our accrual versus cash basis. So the accrual basis, what we've been talking about, that's what we're learning. That's what we're going to be doing is an accrual basis. Cash basis means you only record things when cash is involved. So if I sold something and I collected the cash, then I record it as a revenue. If I'm paying cash out for something, I'm recording that as an expense. If I'm doing the accrual basis, that's not always the case, because remember I said we have that unearned revenue. Let's say somebody paid me for a job that's going to happen in the future. Maybe I'm doing some contract work for accounting then over the next 2 months. I'm recording my cash on the books, but I'm not recording my sale yet. Not until I actually have it. So we talked a little bit about that with our principles last week when we went over the matching principle and the revenue and the expense match and the period of time when they actually are incurred or when they've happened. So that's the difference between the two. So if we do anything with accrual or cash, if I ask anything about that, it'd be real simple, just a couple of transactions, and you're going to be looking to see what was cash involved in, what transactions. And if I say, okay, I want the cash basis for that, you only pull in those cash transactions. It's real simple. If it's accrual, you're looking for the transactions that are happening, even if it doesn't involve cash. All right, that's recognizing our revenues and recording them when they actually happen, or when we're expecting that we're going to receive the money and when we're going to have the sale from that customer. So we also have recognizing the expense when they're recorded when they actually happen. And so we talked about the matching principle, but that's basically matching those expenses with the revenues. Okay, so we have 3 steps in the adjustment process. We want to determine what the current account balance equals, and we want to determine the current account balance, what it should equal. The difference is what our adjustment's going to be to get us where we need to go. All right, prepaid deferred expenses. So we have prepaid expenses that are assets. We paid for them in advance and we're going to receive the benefit in the future. So prepaid insurance is a real big one. Sometimes there's prepaid rent, sometimes it's supplies. We buy those supplies, we put them on the books as asset. We don't use them all right now. We're going to use them over the next few months. So we want to know how do we record that when it happens? So for insurance, we purchased this policy for $2,400. It's covering 24 months. So on the books, when we bought it, we recorded it to reduce our cash and we put it on the books as a debit. It's an asset, so it carries a debit balance as a normal balance. So this is the account, prepaid insurance, and my balance in the account right now is $2,400. Well, how do I figure out, how do I recognize part of the expense? And so that depends on how we're going to be doing the entry. Are we going to do this monthly, quarterly? The problem will tell you how they want it. So it says the balance in the prepaid insurance should equal $2,300. So we're saying, okay, it's supposed to be $2,300, but right now it's $2,400. That's because I want to record 1 month of expense. So if I take the $2,400 divided by 24, it's $100 a month. So I want to recognize that $100. I need to get to $2,300. How do I do that? Well, I need to reduce my prepaid expense by $100. So it's an asset account. So I'm going to credit. And then my expense is going to be $100. So my expense is a debit. And it's just showing you those 2 accounts right there. So here's a T account. It's showing you, okay, I have $2,400 less that 100. So now my balance is $2,300. And on my expense side, that's going to hit my income statement, I have $100. Okay, so this just shows you the journal entry of what we actually did. All right, now we purchased a $97.20 of supplies in December, and some of them were used in December. So we've already done the transaction where we bought them. They're on the books. Now, when we do our physical count at the end of the year, it's showing that the balance is $86.70. So the difference we used. So I need to reduce my supplies down to what I actually have so that I can record what I used. So what am I going to do? I'm going to subtract, and I'm going to get the difference, and I'm going to reduce my supplies. So we're going to credit the supplies by the $10.50 to come up with the balance of $86.70. Our adjustment to supplies expense, because now I need to expense it because I've used them, is a debit for $10.50. Here's my journal entry to show the transaction, what I did in order to get it to post to those accounts. And it shows me my T accounts that gives me my balances. So now I'm sitting with the correct balance for my supplies. And we learned about depreciation. So for this class, I'm only going to bring in straight line depreciation. I'm not going to, we learned different methods and principles, but we're not going to get into all of those. We're just going to talk about straight line. So all that is taking the asset cost, which is what you paid for it, less the salvage value, divided by the useful life. And let's see, we'll go through an example here so you can see. All right, so we purchased equipment for $26,000. It has an estimated useful life of 5 years, and it's expected to be worth $8,000 at the end of the 5 years. So now what we're going to do is just plug it into that real simple equation to figure out how much is that per month, how much is it per year, you know, depending on how you want to calculate it on what they're asking. And then we'll know what to record for our adjustment. All right, so here's my original cost, $26,000 less the $8,000 salvage value. So my net cost is $18,000. So $18,000 is what I'm going to be looking to divvy up over 60 months or over 5 years. So if they want to know how much is it for the year, you would divide it by 5, and that gives you the amount for the year. If it asks that they want, you know, for 60 months, how much is it per month, then you would divide it by the 60 to come up with the number for the month. So we're calculating for 1 month, and that gives us $300. So not the 26,000 divided by the 60 months. Remember, you got to subtract that salvage value out. Okay, so we have our equipment on the books. We don't mess with that. That stays the same. That will never be reduced, only through a contra account. Accumulated depreciation is called a contra account. So I'm reducing that equipment in this other account over here. To get the net, I'll show the 26 as my equipment less the depreciation, and I'll show the net on the balance sheet. Here's my depreciation expense for 1 month, $300. So right here is my adjustment. I'm debiting depreciation expense, and I'm crediting accumulated depreciation. That's my journal entry, my 2-sided double entry. And here's the entry right here. Okay, so it's saying, what is it, you know, after 3 months here? Is that what it is? 3? Yeah. So it's looking to see what is it after 3 months. So, so the equipment goes from 26,000 less the account, accumulated depreciation for the 3 months. So it's 300 a month. So it's less the 900. So the balance on the asset side is 25,100. And then on the expense side, which isn't showing you here, it's $900 in expense. Okay, so now we're going to talk about deferral of a revenue. So we have unearned revenue, which is the cash received in advance for products or services. So remember, we need to record that cash, and we also got to put the liability on the books, which carries a normal balance of a credit. So we're going to have a credit on the books. And so now we're going to probably, we're going to go out and we're going to perform some of those services. So we need to make an adjustment. So this is showing you that the client paid for 60-day fee in advance for a period of 12/27 to 2/24 for $3,000. So we have our journal entry recording the cash. We have $3,000 sitting as a credit in our unearned revenue account. So now we earn payment as the time passes. So it's at 12/31. We have 5 days of service, and we earned 5 days of service. So it's over 60 days. So it's 5 divided by 60 times the 3,000 to come up with how much is it for those 5 days. So $250. So out of the $3,000, I've provided services of $250. So I need to reduce that unearned revenue. So I'm not collecting cash. I'm not giving cash back. I'm just making an adjustment so I can get my account where it needs to be for the unearned revenue. So we're gonna adjust the unearned revenue, and we're gonna put it into a revenue account because now I've earned the services. So here's the unearned liability on the books. I'm reducing it by debiting the account. So now it's been reduced down to $27.50. And on my revenue side, I'm increasing my revenue because I actually provided the service of $250. So that increased my revenue. So I decreased my unearned revenue, and I increased my revenues. There's the journal entry showing my debit and my credit. Okay, now we have accrued expense. So we have costs that were incurred in the period, but they were both unpaid and unrecorded. That means, let's say in the utilities again, during the month, the way that the bill comes through is, let's say it runs from, the 15th of the month till about the 15th of the next month. And I want to record, let's say I'm in July or August. Let's use August because we're in August. So August 15th to September 15th. I'm not going to get that bill until September. So the bill that came in July through August, that only has half my expense for August. So I need to make sure that if I'm going to be looking at the end of the period for August and I want all my expenses to be in there, I may have to go in and record a portion of what's to come in September into August. So I haven't gotten a bill, I haven't spent any money, but I have to make sure I get that on the books. And so that's called an accrued expense. Okay, so we're going to look at this through accrued salaries. So we have the employees, they get paid $70 a day, $350 for a 5-day work week, and they're paid every 2 weeks on a Friday. So at 12/31 is a Wednesday. We need 3 days of salaries, which equals $70 times 3 days to come up with $210. So we need to make the adjustment to record those 3 days. So it's $210 as my expense for salaries. Well, I'm not paying them yet, because remember, I'm not paying them until that Friday. So I need to put that into a salaries payable. So that way the expense is in the correct month. My liabilities on the book saying, okay, I have some payroll that I'm going to have to pay in the future, but I don't want the expense to hit in that period. I want the expense to hit in this period. So I made an adjustment. Okay, so here's my salaries payable, 210. My salaries expense, I'm increasing the expense by 210. And here's my journal entry. So now, when I am going to pay on 1/9 of the next year, I have my full 10 days. But remember, I've already expensed 3 days of that in the period in December of the previous year. So I need to adjust all of the payable off the books, because now I'm taking care of paying all of those 3 days that were recognized as an expense in the previous year. I need to get rid of that. If my normal balance is a liability and that's a liability, how do I get rid of that? I have to debit. I'm debiting salaries payable, but only for the 3 days that I expensed the previous year. So $210 that was expensed in December. That is going to reduce that payable and bring it down to 0. Then I have to record the expense for the 7 days that happen in the January period. So I record the expense in January for the $490. I wouldn't record the entire $700 of expense because we didn't incur it all in January. 3 days of it was in December. This is very common to do with payroll. They do this quite a bit. Okay, so then we have our cash, $700, because we're paying it out. Okay, we can do the same thing with our revenues. We can, the accrued revenues, or the revenues that we earn in a period that are both unrecorded and we haven't received the cash yet. So maybe I provided a service and I haven't gotten the cash yet. How do I get that on the books? Well, accounts receivable. It's something we're going to receive in the future, and we want to keep track of it. So you want to not put it on the books. You want to make sure you put it on there, get it into the receivable account, so that way you know what people owe. All right, so we have a customer that agreed to pay $2,700 on 1/10 of the next year for future services over the next 30 days. So on 12/31, 20 days of service have been provided and earned, which totals $1,800. So then we're going to make an adjustment. So we do the 2,700 times the 20 days over 30 days, and we come up with our number, 1,800. So we're going to put our receivable on the books for $1,800 because we don't have the cash yet. They're going to pay us in the future. And we're going to get our revenue on the books for that particular service that we have already provided. So we don't want to put it to unearned because we actually did do it. So we want to make sure we put it into revenue. So this shows that we have accounts receivable now increasing by 1,800, and we have our revenue that's going to be a credit, and that is increasing our revenue of 70 until by $1,800 to give us a balance of 7,850. Okay, so now we're looking at when they pay this in the future, not only for what we did in the past, but now what we've done in the current quarter. So we have the accrued revenue at the end of one period, which results in cash, plus we also have, you know, the one that we had done the last month. So on 12/31, they record the accrued revenue earned of $1,800. So we did that. Now on the 10th of January, we receive the cash. And we're going to record the cash for the 10 days that we've provided the consulting revenue. 20 days was already recorded in the previous year. So we're going to clear the accounts receivable account because they're giving us the cash now. So we're reducing the accounts receivable, but not by the full amount that we got the cash, because we only recorded a portion of it. Some of it is for services provided in January. So those 10 days, they're going to go to our revenue account. And then we're clearing the receivable for what we put on the books in the previous month in December, which is 1,800. And then we get cash for both. So we have cash for the receivables from the services that we provided last month. And we also have the cash coming in for the revenue for the services we provided this month. Do y'all have any questions so far on the adjustments? Because we'll have some questions on homework and on the test on adjustments that don't have anything to do with cash. It's just making adjustments in accounts.
No questions.
Okay.
At least from me.
Okay. Okay, and so the rest of the chapter is just kind of going into what it looks like with the I lost my mouse. Here it is. Let me get it onto this screen. So I have 3 screens in front of me, and for some reason this one did not want to come over for this screen. Okay, so we have income statements and closing process. We're not getting into all of that for this particular class. I just mainly wanted to go over those adjustments to make sure you understood how to do them. There's going to be some problems on there. And I may have something very, very simple when it comes to an income statement. There'll just be a few things. So if you look at Canvas, there's a sheet on there with some practice problems. I'm going to bring that over real quick and look at that real quick. So in red is giving you what you would do. So we purchased 10,000 in supplies with cash. How would they record it? So I'm telling you what they would do as far as a journal entry goes. So that way, if a question comes up on the test on how to do a journal entry for that type of transaction, you would have it there. It'll be in a journal entry format though, the answer. Or I might ask just one piece of that. You know, would you debit supplies? Would you credit cash? It may have, you know, a debit cash, and you'll have to select the right answer. And then how would you record the transaction if it was purchased on credit? These are all things we went through today. If they did a physical count of the supplies and, you know, the supplies was reduced and the difference is a certain amount, how would you record that transaction? Here's the prepaid insurance on how you would do the calculations and record it. Depreciation, make sure you know this little formula here for the cost minus the salvage value is gives you the useful life. We have the actual question about the depreciation. How much would it be? What is the adjusting entry going to be? So what happens when you purchase it? How do you set it up? And then also when you're calculating, how do you calculate that formula to know what you're going to be doing for an adjustment? So be careful of the dates. So this one says, what's the adjusting entry at the year end? So you need to look at your dates. So if we're looking at something that we bought in January, its useful life is 4 years. It has a salvage value of 3,000. So we have to remember the formula. We take the cost, 15,000 minus 3,000. So that's $12,000. And it's divided up over 4 years because that's my useful life. So it's $3,000 a year. So the question says, what's the adjustment at the year end? Well, in this case, we bought it in January. So we know we're going to have 12 months because it wants to know how is it going to be recorded for the first year? The question may not say the first year. It may say, the first 6 months. It may say 3 months. So you just have to know what you're actually calculating. So when you do that 15 minus the 3 to come up with the 12, and the useful life is 4 years, you're dividing it by 4 because you want a year. But if I wanted to say, how much was it for a month? Well, then you would probably use the months instead. You could still divide by 4, and then you come up with your number and you say, okay, that's for a whole year. So I'm gonna divide that by 12. Whatever is easier for you to help you understand how to come up with the number, but just pay attention to the dates. An example of the unearned revenue, we just went through one of those. And then on this last one, I say calculate net income. So here is a list. It's a trial balance. It's got a list of accounts, debits and credits. It's in balance. And I'm saying, what is the net income? Well, how do we calculate that? Revenue minus expense. So it's real simple. Just look for your revenue accounts, total them up. In this case, we had 1. Look for your expenses. So we have salaries expense of 2,000. We have utility expense of 800. So I have 2 accounts there that I have to add up. And I just take the 7,500 minus the 2,800 to come up with my total, 4,700. So it's real simple. It's nothing too sophisticated. I'm not trying to really confuse you on this test. It's literally just basic things that you learned from principles. And so don't freak out too much about complications and all that. Just make sure you know how to do the homework, know how to do these little practice homeworks, and you should be fine for the exam. So next week is the exam 1, which is going to cover just the basics that we learned, concepts and stuff that we learned last week, and then covering the information that we learned this week. So just understanding the accounts, the general ledger, what those are, how to do those simple adjustments. And so when we move into the managerial part of this, when we start the book, so we're doing a lot of calculations based on how we're calculating manufacturer's overhead. Well, so you might not be looking all the time at journal entries or financial statements, but I want you to have a basic knowledge of what's happening on the cost side to kind of have an idea how this is affecting the organization. So I think reviewing this helps with that. Okay, so do y'all have any questions at all about any of the homework questions or anything we went over tonight? Test next week?
So the text next week is going to be online?
Yes, ma'am. It's going to be on the Connect website. I'll open up the test probably on Thursday morning, and it'll be open until Sunday. So you'll have several days to, fit that in there. But just keep in mind when you start, you have that hour and a half that you can't pause it and come back to it. You have to do the whole thing once you start it.
And I just had a question. So is it like the Respondus lockdown browser where you show your ID? Is it that same format like we've done in? Okay, I just want to make sure. So
yeah, it should be. It should just have the you're gonna have to have the video, you're gonna have to have internet connection. So just make sure you're in a spot that if you've done this before, that works. Sometimes that's a problem with internet because we don't always have the best internet that comes in. I try to pay for the best service that Cox has, but I still don't get good service sometimes. So I don't know what happens, but that happens. So just keep that in mind when you're going to take it. Don't wait to the last minute to take it. So that way you can,
And you said it opens up on Thursday, right?
Yeah, it'll be open up on Thursday.
So we don't have a class on Thursday evening?
No,
Okay.
we won't meet Thursday night for a Zoom session. You will just have that week to finalize, study, do the tests when you're ready over the weekend, and we'll meet back the next week. After that, we'll start chapter 1.
All right.
If you have trouble with any of the information, just send me an email, listing it all out, and then text me and let me know you sent me something. And then I'll get with you to try to schedule a time that we can work through something, or maybe it's something I can email back. If you just have a snapshot of something and need help, I can help you.
Are you gonna send out an email leading up to just to remind us about the exam?
Yeah. I'll send an email just saying, hey, just a reminder, test open. I'll put on there that it's been opened on Canvas. So the link, so your link should be in Canvas just like your homework is. That you can go ahead and get started and let you know when it's going to be open till. I'll probably send one if I'm looking at Connect and I'm seeing that people haven't taken their exam on Sunday. Probably going to be sending an email. Hey, make sure you get that test done. It may go to everybody because it's hard to just single out people. So I usually just send an email. Hey, see, some people still haven't completed the exam. Make sure you get that done. I do the same thing sometimes with homeworks. Okay, so if that's it, that is it for tonight. It was a short class tonight.
Thank you.
Thank you. Y'all have a good week.
Thank you.
Thanks, you too.